Now time for an exclusive conversation with none other than Mark Mobius, where he talks about his view on reforms in India, consumption patterns, and why NBFCs and infrastructure stocks are on his radar. Nikunj caught up with him earlier and began by asking him what he finds interesting in India.
Just tell us more about your current allocation without getting into size, but I just want to understand that what's your current, where have you been shopping?
India is right up there with China. China and India are the biggest. And I believe now India's surpassed China in the allocation. Then you have Brazil. We have a little bit in Russia. Wish we had more because Russia's done very, very well. We're in Turkey. And we have a little bit in Indonesia. Those are the main countries.
What's your pitch and what are you buying in India? Are you still buying the good old private banks, which some would argue, and consumer names which are crowded? Or you are ready to bet on some cyclicality and beta in your portfolio?
We want to buy stocks that are really bombed out. And of course, the non-bank financial institutions were one focus that we looked at. And the other area was infrastructure. In other words, companies that supply the goods and services that build the infrastructure. Those are the two areas that we looked at.
What do you make of the current slowdown in India? Slowdown which is now, I mean, everybody's talking about it, we are admitting it. There are pain points which are available. So there are green shoots and there are yellow weeds. But markets are nervous about what's actually happening to the Indian economy. As an outsider, as an investor, what is your view?
Well, the way I look at it is, hey, 5% is very good growth for a country this size. Yes, it's down from where it was, but you must remember going forward, it's going to be more and more difficult to achieve 10% growth that you had previously, simply because the size of the base is getting bigger and bigger. It's getting more difficult. And the same thing with China. You know, 10% growth in 2010 for China was smaller in dollar terms than 6% growth today, because the pie is much bigger. So that's one thing. The other thing is that I think, you know, when you're introducing so many reforms and changes, as Modi has been doing, there is always a period of sort of shock, where people say, oh, wait a minute, this is a big change, let me hold back, maybe wait, you know, this is a new tax, I don't quite understand this, so forth. So then you would tend to have a little bit of a slowdown. But I believe by next year, you'll see a big pickup again, when people get used to the reforms that are being implemented.
Mark, we've not had a clean year of earnings in India. First, it was demonetization. Then we had the transition of GST. Then we had the LNFS crisis. This year, you know, the base effect and, you know, slowdown in autos has hit us. Do you think now we could be in for 1 or 2 years of clean earning? Whatever wrong could happen has happened. Now the system is cleaned up. In India, the IBC Act has kicked in. NCLT issues are getting sorted. Do you think the darkest dusk before the dawn is over?
Well, that's what I believe. That's, as I just mentioned, I think that a lot of these reforms that have been kicking in have sort of upset the apple cart, so to speak. In other words, a lot of people are confused how to react to this, how to react to that. And by next year, I think people will begin to become inured to these changes and will be able to move forward.
India has always commanded a premium for its high governance standards. The P multiple in India is much higher than any other emerging market. Just a look at a basket of good banks, good companies. They trade at they get commanding valuations. Given that last 6-8 months has not been exactly great news for good quality promoters, where corporate governance issues have been exposed, leverage concerns have come to fore. Is there a challenge that Indian companies which historically have commanded high premium because of quality of business and return ratios, that could get challenged?
If they continue to have good governance, there's no reason why their stock prices can't continue to move upwards, provided that the earnings come in and they're able to adapt to the new internet society. But those companies, you must remember, because of the internet, because of smartphones, because of this incredible speed of communication, it's going to be more and more difficult to hide poor corporate governance. And more companies will be exposed if they have bad corporate governance. and that'll affect their share price. On the other side, those that have really good governance and are more transparent will do quite well, I believe. I mean, it's true globally, by the way, not just in India.
Mark, you've been investing in India for about 20 years plus now?
At least, yeah.
At least 20 years plus now. What has, in your journey as an investor in India, what has always surprised you, and where have you been impressed consistently, and where have you got disappointed again and again? You've taken your chances, but they've always gone wrong.
What surprised me, of course, is the tremendous strides in the growth of the markets, not only in terms of size, but in terms of digitalization. I mean, I remember, I don't know, many of you people may remember the old Bombay Stock Exchange.
Right.
It was like a parking lot. It was an open air, and people were with physical delivery. I remember people carrying their certificates on their shoulders. I mean, this is...
You've actually seen that?
Yeah, I remember. It was just amazing to me. And then the National Stock Exchange came, and then you had the digitalization, and that tremendous changes taking place. So these are the changes that we've had, and looking forward, we're going to have more going. There's going to be more of this.
So what has disappointed you? What would you say where you've burnt your fingers? Because what this audience wants to do is that they want to learn from your experience. Put in your experiences, say that this is 1, 2, 3. Please avoid them in investing.
By the way, this is true not only of India, any other part of the world. What disappoints most is the corporate governance, the managements of companies. The managements will tell you one thing and then do another. Or they may be hiding something under the table. This has been the big disappointment, the transparency.
Can you give an example?
I bet I give you an example because we may get into trouble. But you know what I mean.
I don't know what you mean.
Well, I mean, let's take an example from America. That's a safer place to talk about. Enron.
We know about that.
You know about that.
Tell us something new.
Yeah.
Tell us something different. Tell us that what we say, the inside gossip of investing in India.
I'm trying to think of an emerging market. Oh, I'll tell you another one. In Brazil, Mesbla. This was a Brazilian department store. By the way, this is another example, another warning. Don't just talk to the finance manager. Talk to the chairman and to the people who control the company and look at their background. But anyway, we invested in Mesbla, which is a very successful, at that time, department store in Rio de Janeiro. And we would talk to the finance manager each year. Things looked good. You know, earnings were going up. Things were great. Then all of a sudden, company's bankrupt. All the assets are gone. They had a car leasing company, that was gone. They had this and they had that, it was all gone. What happened? And we tried to find out. It was almost impossible because the company had been robbed, basically. So one day, about a year later, it was about a year and a half later, we went to the CVM. CVM is the SEC of Brazil. And I said, look, we'd like to talk to one of your directors about Mesbla. We want to find out what happened. And he said, no problem, we'll get a director. And this gentleman comes out. The former finance director of Mesbla is now with the CVM. This is the situation. So I would say this is the...
Has that happened to you in India also?
In India, yeah, of course it happened. It happened. As you all know. I mean,
nobody knows, Mark. You're the most experienced person in this room. You want to learn from your experience.
I don't want to be. Let me leave town first, and I can tell you.
Mark,
that's the reason why I tell people, look at the backgrounds of the people. Try to find out what's their motivation. What is their background? What are their extracurricular activities? Who are they friendly with, et cetera, et cetera.
How has life changed for you when you were managing money for Templeton versus when you're managing for your own firm now? How do you manage it differently?
The difference is that I have more of my own money in these funds than the Templeton funds. Of course, I had money in the Templeton funds, but Templeton was so big. The difference is that we're more focused now. We focus on just a small segment of the universe, whereas with Templeton, we're all over the world, and also in different sectors.
I want to go back to the initial point of your talk, which is value investing is not dead. Do you think we need to understand what value stands for, and measuring value cannot be P multiple and price to book? A classic example here is that, oops, that happens in India, don't worry. How do you define value? Just because something is cheap does not mean it is attractive.
Oh, that's why I mentioned that it's so important to look at the management of the company, the ownership of the company, and find value in these people, the people that are running the company. In other words, are these people capable, high quality, high moral standard? This is part of the value equation. In other words, just looking at the numbers is not enough. You've got to go behind the scenes and look at that. And then the second thing, as I mentioned, try to focus on what is more easily verifiable.
Okay.
Cash dividends are verifiable. Earnings are not so easily verifiable, if you know what I mean, because they can be manipulated. So the big challenge we have is that accounts of companies are done by auditors, or audited by auditors, and these auditors are hired by the management and by the boards of directors. Okay. So you know what side they're going to be on. Now, I'm not saying they're dishonest in any way, but they would tend to make the statements look a little bit different than they otherwise would be. So you've got to dig behind.
Okay.
So that's the reason why very often when we look at a company, I tell the analysts, the first thing they want to do is talk to the management. That's fine. But I tell them, if you really want to learn about a company, don't talk to the company. Talk to their competitors. Talk to the market. Because you'll get another view of what's happening to the company.
I'm going to just throw it very wide open. In 1980s, if you invested in Japan, you hit a home run.
Yeah.
If you invested in US blue chips in 1990s, trust me, it was like a golden decade. The last decade exclusively belonged to emerging markets and India. Last 10 years have been extremely kind to America. It's peak America. American economy, American stocks, American financial asset, American unemployment is at an all-time low. Which is that trade for next 5-10 years? Because that's the way world has moved. Every 10-12 years, the trend, the cycle, the geography, and the magnification changes.
Obviously, emerging markets, because if you look at India and China, particularly India, India, I believe, is now at the cusp of a big breakthrough in terms of growth and prosperity. So you have to look at these countries that have the potential to grow a lot faster in terms of the economic size of the economy. And I believe India is right up there. China, of course, has had already very, very good growth. They're going through a difficult patch, but they will still be good. But then there are a number of smaller companies. See, the problem in discussing this is that if you're an equity investor in an open-ended fund, you cannot buy illiquid stocks. That's for private equity. So if you look at the universe of opportunities around the world, where would you want to be if you had the ability to invest long-term without needing the liquidity? It would be Africa.
Okay.
Because Africa has got some of the fastest growing economies in the world, and Africa is now in a situation where they are able to leapfrog the technology continuum and go into the latest technology. And this is a tremendous boost to productivity.
Good
So
point.
that's why it's very difficult when you ask, what's the best place to invest? Of course, I have to think about liquidity, which means China, India, Turkey, South Africa, etc. But then if you are willing to take a long-term view and go into private equity, that would be places in Africa.
One last, question from my side. You've been managing money for others. You manage billions of dollars. Now you're managing money in your private fund. If you have to give your wealth to someone to manage, whom would you give it to? Whom would you trust with your money?
I wouldn't trust anybody.
Yeah.
No. And with investing, just like with anything, any other process, you've got to diversify.
Okay.
In other words, it's not a good idea to give it to one person.
So, Mark, if a client walks up to you and says...
I would prefer to say, give it to 4 or 5 fund managers. This would be a safer way of doing it.
So if a client says, Mark, I heard you at the ET Summit. I want to give you my money to manage. You'll say yes, I'm assuming, right? But if the client requirement is, Mark, here's my $50 million. You're free to invest. I don't care about a 10% downside, 20% volatility. I don't care whether you invest in Turkey, China, India. I don't care. All I want is my money to double in 5 to 6 years. How would you invest?
How would I invest?
Yeah.
I would do exactly what I'm doing now. I would go, first of all, into emerging markets. I would look for good value companies. I would try to help improve the corporate governance of those companies and do it that way.